If you're working a 9-to-5 job, you're probably the IRS's favorite kind of person, because the more you earn, the more they take. Now, chances are, if you live in a major city, or you're in a field like finance, tech, or the medical field, you're making a lot of money. You're making $250,000, $500,000 a year, $1 million a year. And a third of that is easily gone to taxes. It's kind of crazy to think about. People mostly think that your mortgage is your biggest expense, but in reality, it's taxes, if you don't know how to structure them right. Think about it. While you're grinding these 50, 60, 80-hour weeks, someone else is collecting rent checks, paying less in taxes, and compounding their wealth quietly. And here's the kicker. It's not because they're smarter than you. It's just that they know how to play the game better. I'm Leo Young, and I help high-income earners like you build tax-efficient wealth through real estate. In this video, I will show you 3 common techniques savvy investors use to lower their taxes, increase their compounding, and leave a legacy without giving Uncle Sam a third of it. These aren't loopholes, they're laws, and they're available to you too, if you know how to use it. And this is not financial advice, just strategies that I see other wealthy people use, and I use myself too. So the first strategy is depreciation. What is depreciation? It's when an asset loses its value over time, and the IRS lets you write off the value on your taxes. So it sounds like it makes sense, right? If you buy a car last year, this year is probably worth a little bit less. So what's the significance of it? One of the most common assets used for depreciation is real estate. Let's say you buy this building for $1 million or a piece of property. If it's a residential property, you can depreciate it over 27.5 years. And if it's a commercial property, you depreciate it over 39 years. So what that means is the IRS allows you to mark a portion of the property's value as a loss on your taxes every single year for 27 to 39 years. So if you bought $1 million house, you can write off around $36,000 in your taxes each and every year. That's a loss that appears on paper. And if it's a commercial building, you can write off around $25,000 each year. And how you calculate that is you just take the property's value and then you divide it by 27.5 if it's a residential property, or 39 if it's a commercial property. Now here's where it gets interesting. So you rack up, let's say, $25,000 in depreciation that year. That shows up as a loss on your taxes. Then when you're collecting rental income, let's say you collect $25,000, just for nice round numbers, in income that year from the property, then you technically don't owe the IRS a single dollar that year, because the loss cancels out the revenue. And you compare that to something like your job or stocks, for example, and let's say you make $25,000. You're automatically giving around $8,000 back to the government, because there's very few deductions for your W-2 job or gains from stocks. And that's why people like to invest in things like real estate. Now, to take a step back, why is depreciation even a thing? Yes, fundamentally, we covered why it makes sense that an asset loses its value over time, but it's also to incentivize people to invest more in things that are useful to the economy. So if you're buying a large tractor trailer, for example, you're investing in agriculture. You're helping America produce more food. Whereas if you're buying a building, then you're providing housing, you're providing a space for a local business, or even your local pastry shop. So okay, that makes sense. Now, a quick little bonus is that if you're a real estate professional, let's say you're a realtor, a mortgage broker, then you could benefit from depreciation even more, because you can use your passive losses from depreciation to offset your active gains. So that's why you'll see a lot of real estate agents invest in property themselves. In fact, you might see husband and wife duos, where one person is an investor and the other is an agent, so that the investor buys buildings and accrues the depreciation, then uses that to offset the other person's income. Then they pay even less taxes overall. And yeah, it sounds a little bit unfair, but I guess the reason is that real estate professionals have a high velocity of money for that kind of economic activity. That's why it's in the tax code. So if someone buys a piece of real estate, they need an agent, they need a mortgage lender, they need a title company, insurance company, contractors. So $1 effectively gives 5 people jobs, at least 5. Those are just a few people I named. So that's why real estate and real estate professionals are able to benefit so much from the tax code. I mean, if you think about it simply, the tax code is a set of incentives and disincentives made by the government to drive certain kinds of activity in the economy. So okay, another bonus on top of this is bonus depreciation. Bonus depreciation is a tax incentive that allows you to immediately deduct a large portion of the asset's value rather than depreciating it over time. Instead of depreciating an asset over 39 years, you can take a large majority of it in year one. And that sounds pretty crazy because you can literally get hundreds of thousands of dollars of depreciation liability, aka write-offs, in year one for taking advantage of bonus depreciation. In fact, that's what we do for a lot of our investments too. So to give you an example, and we do that through a cost segregation study, which essentially breaks a property into more accurate components. Because if you take a look at a building, for example, the concrete building itself should have a different useful life than the light fixtures, than the elevator, than the carpets. So a cost segregation study will segregate that cost into a few different buckets. And then it will allow you to take a certain amount of those costs up front in year one. So let's say you invest $100,000 into one of our mobile home park deals. We run a cost segregation study and we identify $60,000 worth of depreciation that we can allocate into year one. And if you assume right now you can write off 40% of that amount, then that's an immediate $24,000 in tax write-offs for you, which you can either use to not pay taxes on the cash flow from your property through the next 5 years, or you can use it to pay much less taxes if you're a real estate professional. So this lets you front load your losses and lets you keep more money in your pocket after taxes, or the lack thereof. Now the second strategy is 1031 exchanges. This is what we call a tax deferral exchange. There's a quote from Charlie Munger that goes, "The first rule of compounding is never interrupt it unnecessarily." So what a 1031 exchange does is that it allows you to sell one investment property and reinvest the proceeds to another without paying capital gains taxes at time of the sale. And why does that matter? So you don't interrupt your money while it's compounding. The effects are pretty amazing if you're able to chart what the same returns look like. Let's say if you invest in stocks and you're paying your 10 to 30% taxes every time you sell a stock just to reinvest it. So your gains will go like this. It will zigzag up. Versus in real estate, if you keep on using a tax deferral exchange, it should just go up much, much faster because you're not getting that cash drag from the taxes. Now again, this sounds like another crazy tax loophole that doesn't sound fair at all, but that's because the US government wants to incentivize people to invest in things like real estate and keep their money in the US economy. And that's very important because with the 1031 exchange, you cannot take the money out. You have to keep that same amount of money in, and you can only put more. If you take anything out, that part is taxed. So it really incentivizes people to roll up these massive snowballs over their lifetimes because then that keeps more wealth in the US. So a lot of real estate investors do this. They'll buy or invest in a property, improve its value, exchange it to the next one, do the same thing, exchange it to the next one, and so forth. And that leads me to the third strategy, which is the step-up basis. So what happens after you've built this massive snowball of assets and real estate holdings? You're gonna have to pay taxes on that, right? Well, not if you pass it down to your kids. Because when you pass it down to your kids, then the cost basis of the asset gets stepped up to the current fair market value at the time of your death. Now, we don't like to think of this, but this is how generational wealth is built. You like to see those trust fund babies and those rich people and think like, how do they even get there? And it's because their parents or their grandparents learned the tax code and they used it to their advantage. And look, success compounds over time. Good things don't happen immediately. So how the step-up basis works is that when you pass down your holdings to your heir at the time of your death, then the tax liability is erased and you inherit the property as if you bought it at today's value. So you can sell it immediately with zero capital gains tax. And again, the reason why this rule is in place is A, to make sure that the assets stay in the economy, but also B, to help ease the strain on the government's resources. Because imagine you're doing 3, 4, 5, 7 of these 1031 exchanges through your life, and even more if you're a house flipper, for example, then how is the government going to calculate exactly how much tax you owe and when? and make all those deductions and depreciations just for a little bit of tax revenue. It's a lot. So this is sort of a win-win in that they keep the money in the economy, they ease their strain on their resources, and you get to keep wealth in your family. So let's put this all together. This whole strategy constitutes the buy, borrow, die strategy, which is what you might have heard of that a lot of wealthy people use, is that they buy assets, they borrow against it tax-free, and then they die and they pass it down to their heirs at a stepped-up basis so that they avoid the tax liability. And that's how you build generational wealth. So I'll give you an example. We buy with our investors a $3 million mobile home park, and we raise $1 million in equity. So 10 investors come in at $100,000 each. The property generates $8,000 in cash flow per investor per year, which you're not paying any taxes on because of depreciation. Then as we grow the property and we sell it in year 5, your investment has effectively doubled. So you take that $200,000 and you roll it using a 1031 exchange into the next property. And then you repeat that process over and over again. And you're not paying taxes on any of it. It's money straight into your pocket. And the craziest thing, none of this is a loophole. This is literally written in the tax code. They want you to use it. The sad part is that most high income earners are too busy to read the tax code and take advantage of it. Now remember, income makes you rich, but structure gets you wealthy. If you want to escape the earn and pay salary hamster wheel, focus on assets that give you depreciation today, optionality tomorrow, and a tax blueprint your heirs will thank you for. If you want to see what kind of returns you can expect investing in real estate, check out this video here.